Listen closely, because what I'm about to reveal has been deliberately buried by the mainstream financial media. A leaked internal memo from one of London's largest bullion banks just crossed my desk 3 hours ago, and the language inside is absolutely chilling. The word they keep using? Unsolvable. Not difficult. Not challenging. Unsolvable. Senior executives are privately admitting they're staring down a physical silver crisis that has no precedent in modern market history, and they have exactly 14 days before the trapdoor opens beneath them. If you're over 60 and hold any precious metals, any retirement savings, or simply want to understand what's really happening while the rest of America watches football, you need to hear what I'm about to tell you. This isn't theory, this isn't speculation, this is mathematics meeting reality, and the collision is going to be spectacular. I'm Robert, and I've spent 12 years analyzing physical commodity markets, specifically silver. What's unfolding right now is something I've never witnessed before, and I've lived through the 2011 spike, the Hunt Brothers saga aftermath, and every supposed squeeze attempt in between. But this situation, this is structurally different in ways that should terrify anyone short this market and energize anyone holding physical metal. While the world focused on Greenland headlines Friday afternoon, treating it like just another diplomatic spat, the actual story got completely missed. The administration didn't just float a negotiating position. They deployed what I'm calling a nuclear tariff bomb that has created a one-way valve in the global silver supply chain. And the banks? They walked straight into a trap of their own making. Here's what actually happened. 10% tariffs on imports from 8 European Union nations plus the United Kingdom, effective February 1st. That's 14 days from now. And here's the part that should make every hair on your body stand up. That list explicitly includes the UK, home of the LBMA, the London Bullion Market Association, the single most critical silver trading hub on planet Earth outside of New York. By the time futures markets open tonight, the economic pathway for silver to move across the Atlantic Ocean won't just be expensive. For the bullion banks operating under their standard procedures, it will be economically impossible. But that's not even the devastating part. Let me be crystal clear about what I'm claiming here, because this is not speculation. This is pure mathematics. Trump's 10% tariff, which escalates to 25% if no Greenland deal materializes by June 1st, has created what commodity traders call a geographic arbitrage trap. It has effectively imprisoned millions of ounces of physical silver within United States borders, leaving the London markets to suffocate on their existing inventory. If the LBMA cannot borrow metal from the COMEX vaults in New York to cover their short positions, and trust me, they cannot do this profitably anymore. The global pricing mechanism doesn't just strain, it fractures completely. We're not discussing a normal price squeeze that takes silver from $90 to $110. We're talking about a fundamental breakdown in how this metal gets valued globally. We're staring at a scenario where physical silver could legitimately trade above $100 per ounce, not because of investment mania or inflation panic, but because of a structural impossibility in the supply chain that no amount of paper contracts can fix. And here's what's going to blow your mind. The banks did this to themselves. They saw this coming and made the exact wrong move. Now, before I walk you through the 3 critical mechanisms that are about to converge, I need you to understand something fundamental about precious metals. Gold? Gold is the money of kings. Central banks stockpile it. Governments hoard it behind vault doors. It's the bedrock of the monetary system. But silver is the Achilles heel of the entire banking system. And that heel just got struck with a policy arrow that the banks never saw coming, even though they were staring right at it. As of this afternoon around 2:30 p.m. Eastern, silver was trading at $89.94. down 1.62% from Friday's close. Gold sat at $4,596.87, down just 0.28%. If you glanced at those numbers superficially, you'd think the market was reacting rationally. Tariffs typically strengthen the dollar. Precious metals usually dip on strong dollar news. The algorithms executed their standard playbook. But here's what the paper market fundamentally doesn't grasp yet: the physical reality unfolding underneath those ticker symbols. While paper prices dipped slightly Friday, the bid-ask spread started widening. Not dramatically, not in a way that would trigger CNBC alerts or mainstream coverage. But if you monitor actual physical dealers like I do, you saw it happening. The spread between what someone will pay for an ounce versus what someone will sell for started stretching. And the Friday night surprise, the actual tariff announcement that dropped after the LBMA had closed for the weekend? London doesn't even know they're trapped yet. Let me give you context that makes this situation even more insane. First quarter of 2025, we watched dozens of millions of ounces of physical silver flee London vaults and land in New York. The bullion banks thought they were being clever. They were front-running the Section 232 review that everyone knew was coming. Section 232 is the mechanism the administration uses to determine if imports threaten national security. Silver, as a strategic mineral used in everything from solar panels to missile guidance systems, was obviously on that list. So the banks did what banks do. They repositioned their physical inventory from the LBMA into COMEX warehouses, thinking they'd be safe from any supply chain disruptions. They moved the metal to protect it from import restrictions. And now, with one weekend announcement, with one carefully timed policy decision, the door has been locked from the outside. The metal is trapped in New York, and the banks just lost their ability to play whack-a-mole with physical shortages across the Atlantic. Now here's where this gets technical, but stay with me because understanding this mechanism is crucial. I'm going to teach you a concept that most retail investors have never heard of, but that institutional traders literally live and die by. It's called a geographic arbitrage trap, and it's about to strangle the silver market. Here's the simple definition. This occurs when the cost to move an asset between two global exchanges becomes higher than the price difference between those exchanges. When that happens, the flow of supply completely paralyzes. Think of it like this. You have two wallets. Your left pocket, call it London, is completely empty, and you've got a bill due that you need to pay immediately. Your right pocket, New York, is stuffed full of $100 bills. Normally, you just move some cash from your right pocket to your left pocket and solve the problem instantly. But here's the catch. Every single time you move a $100 bill from your right pocket to your left, the government intercepts it and takes $25 as a tax. You're technically rich in one pocket and functionally bankrupt in the other, and you cannot fix the problem without losing 25% of your wealth in the process. That's a geographic arbitrage trap. Apply this to silver markets today. The United Kingdom, specifically the LBMA, is critically short of physical silver. They've got obligations. They've got contracts. They've got delivery demands from funds and industrial users who need actual metal, not paper promises. Under normal circumstances, this wouldn't remotely be a problem. When London gets short, they just arrange a shipment from New York. Metal moves across the Atlantic every single week. It's part of the global flow that keeps prices synchronized between exchanges. The mechanism works elegantly. If silver is trading at $90 in New York and $91 in London, arbitrage traders buy in New York, ship it to London, sell for a $1 profit, and pocket the difference after shipping costs. That constant flow of metal from low-price zones to high-price zones is what keeps global markets balanced. But with a 10% tariff, and eventually a 25% tariff, that metal can never economically return to the United States without the banks taking catastrophic losses. Think about what that actually means. If you're a bullion bank and you ship 1 million ounces from New York to London to cover a short position, you've just made that metal 25% more expensive to ever bring back. The result? Two separate prices for silver are about to emerge. I'm calling them the trapped U.S. price and the starving London price. And when those two prices decouple, when the arbitrage mechanism breaks down completely, we're going to witness something that hasn't happened in modern precious metals markets. But before I show you the exact math, there's something even more disturbing you need to understand about what the banks are really afraid of, and I'll reveal that in just a moment. Let me walk you through the actual mathematics, because this is where theory becomes cold, hard reality. Scenario A, the 10% friction. At $90 per ounce, a 10% tariff adds $9 to the cost of every single ounce imported into the United States. What does that mean practically? It means if silver is trading at $90 in New York and $95 in London, it's still not profitable to ship metal from London to New York because you'd pay $9 in tariffs and lose $4 on the trade. This immediately creates a floor for U.S. physical metal. Domestic silver cannot fall below the London price minus the tariff cost, or arbitrage would kick in and equalize things. But here's where it gets genuinely dangerous. Scenario B, the 25% nuclear option. If no Greenland deal is reached by June 1st, and I personally think the odds of a deal are lower than the media suggests, the cost to bring silver back into the United States jumps by $22.50 per ounce at current prices. Let me repeat that number. $22.50 per ounce. Now, the LBMA is rumored to be critically short. I don't have exact figures because banks don't publish their short positions in real time, but based on the inventory drawdowns we saw in Q1 of 2025, we're talking potential exposure in the range of 50 million ounces or more. If they need 50 million ounces to satisfy delivery obligations, the United States is the only source of available physical metal in sufficient quantity. The premium required to move that metal has to exceed the 25% tariff. Here's the calculation that should terrify anyone short silver right now. Current price, $89.94. Add 25%. That's $112.42. That is the mathematical break-even point for global silver flow under the 25% tariff scenario. $112.42 is not a speculative price target. It's not a hopeful projection from someone who thinks the dollar is going to collapse. It's the minimum price required for arbitrage to function under the new tariff structure. Now look at the COMEX inventory charts. I was studying them a few hours ago, and here's what you need to understand. The registered silver, the metal that's actually available for delivery, isn't moving. It's sitting there. Not because there's no demand, but because the banks cannot afford to let it leave. Every ounce that exits a U.S. vault is an ounce that becomes 25% more expensive to replace. The smart money has already figured this out. They're not selling, they're not shipping. They're sitting on their metal and waiting for London to blink. And this brings me to what I promised to reveal, what the banks are really afraid of. And it's not what you think. Let me pull back the curtain on something that doesn't get talked about enough in the silver community. The bullion banks are not afraid of high silver prices. They've navigated silver at $49 in 2011. They've dealt with higher gold prices. They can hedge. They can adjust their books. What genuinely terrifies them is a market where they cannot move metal to where they need it. The entire fractional reserve system in precious metals depends on geographic flexibility. When London gets tight, metal flows from New York. When New York gets tight, metal flows from Zurich or Singapore or Hong Kong. It's a global shell game, and it only works as long as the shells can move freely. The moment you lock down one of the major shells, the whole illusion collapses. And that's exactly what this tariff has accomplished. It's locked down the New York shell. The LBMA can't borrow from COMEX anymore. Not at prices that make economic sense. Not without taking catastrophic losses on the round trip. So what do? They've got three options, and every single one is terrible. Option 1, they let physical silver in London spike to $100 or more to incentivize existing holders to sell. Option 2, they change the rules and allow cash settlement, which destroys confidence in the entire LBMA system. Option 3, they declare force majeure and admit they cannot meet their delivery obligations. Pick your poison. Every single one of those options is catastrophic for the paper-silver market, and every single one of them is bullish for anyone holding physical metal. But here's the part that makes this situation even more absurd, and it's a scandal the banks desperately hope you've already forgotten. First quarter of 2025, we saw this massive movement of silver from London to New York, I mentioned it earlier, but I want to dive deeper into what actually happened, because the irony is almost beautiful. The banks knew a Section 232 review was coming. They knew silver was going to be classified as a strategic mineral. They knew import restrictions were possible. So what did they do? They moved their metal ahead of time. Dozens of millions of ounces flowed out of LBMA vaults and into COMEX warehouses in New York. It was the single largest quarterly movement of silver between those two markets in recent history. And the beautiful irony? They thought they were being smart. They thought they were front-running the restrictions. They thought they were positioning themselves to be on the right side of the trade when the tariffs hit. But they made one critical, catastrophic miscalculation. They assumed the tariffs would restrict imports into the United States, not exports out of the United States. They moved the metal into the U.S. to protect it from import tariffs. And now they've realized it's the export side that's trapped. It's like a bank robber who breaks into the vault, stuffs his bag with cash, and then realizes the only door out is locked from the outside. They're stuck. And the best part? They did it to themselves. Now, I know exactly what the skeptics are going to say. I've been in this market long enough to predict the counter-arguments before they even show up. Skeptic argument number 1. This is just a negotiating tactic for Greenland. Silver is a strategic mineral. It'll be exempted before February 1st. Here's my rebuttal. Look at the Section 232 review that was completed just days ago. Read the actual language. It purposefully left the door open for broad-based tariffs on all goods from the listed nations. If the administration wanted to exempt strategic minerals, they would have done it in the initial announcement. The fact that they used the phrase all goods is not an accident. It's a pressure tactic designed to maximize economic pain and force concessions. And here's the thing about negotiating tactics. They only work if the other side believes you'll actually follow through. If you announce a 10% tariff with an escalation to 25% and then immediately grant exemptions, you've shown your hand. You've revealed it was a bluff. This administration doesn't bluff on tariffs. We've seen this playbook before. Skeptic argument number 2. The UK isn't even in the European Union anymore. The tariff won't apply to them. Wrong. The announcement explicitly named the United Kingdom alongside the EU nations. Go back and read the press release. It's right there in black and white. 8 EU nations plus the UK. Brexit doesn't protect London from this. If anything, it makes them more vulnerable because they don't have the collective bargaining power of the EU to negotiate exemptions. Skeptic argument number 3. The COMEX will just change the rules. They'll allow cash settlement or adjust delivery terms to avoid a squeeze. This one actually has some merit. The exchanges have changed rules before when things got tight. But here's what the skeptics miss. Changing the rules doesn't create physical metal. If the LBMA has contracts that demand physical delivery and they can't source the metal because of the tariff trap, no amount of rule changes in New York solves their problem in London. You cannot settle a physical delivery obligation with a PDF file. Let me give you my personal dashboard for the next 14 days, because this is about to move fast. First, I'm watching for margin hikes on the COMEX. I expect them by Tuesday or Wednesday. When volatility spikes or when the exchange perceives a squeeze forming, they raise margin requirements to shake out small speculators. It's standard procedure. If you're trading silver futures on leverage, a 20 or 30% margin hike can force you to either post more cash or liquidate your position. This is how they engineer sell-offs in paper markets while the physical market is tightening. Second, I'm watching the media for what I call the blackout. When things get truly dangerous for the banks, you'll see either complete silence on the topic or technical difficulties in reporting. Watch for redefinitions of what constitutes available silver in London. They'll start separating allocated from unallocated, or they'll start talking about liquidity instead of inventory. It's a linguistic shell game designed to obscure the fact they're running out of metal. Third, and this is the big one, I'm watching the EFP spread. EFP stands for Exchange for Physical. It's the mechanism that allows traders to swap a futures contract for actual metal. The spread between the futures price and the physical price is normally very tight, maybe a few cents. If that spread blows out to $1, $2, $5 per ounce, it means the paper market has completely decoupled from the physical market. That's the signal that the system is breaking. Fourth, I'm watching every single headline out of Greenland. Any indication of a breakdown in talks, any statement from Danish officials that negotiations are stalling is a bullish signal for silver, because every day that passes without a deal is another day closer to February 1st when the 10% tariff kicks in, and every day after June 1st without a deal is another day under the 25% regime. The banks have 14 days to solve a problem that's been building for decades. They've papered over physical shortages with derivatives, with leasing agreements, with accounting tricks that let them count the same ounce of silver in 3 different places. But you can't tariff your way out of physics. Here's my personal battle plan for the next 2 weeks, and I want to be very clear before I share this. I am not your financial advisor. I'm not telling you what to do with your money. I'm someone who's been stacking physical silver for over a decade, and I'm watching a train wreck happen in slow motion. This is my personal playbook. You do whatever makes sense for your situation. Trigger number 1, the $92 level. If we open Sunday night when futures markets come back online and silver gaps over $92, I'm viewing that as the market confirming the tariff trap. That would represent a breakout above the recent consolidation range. More importantly, it would show that institutional money is starting to price in the geographic arbitrage trap. If that happens, I'm holding my core physical positions with zero intention of selling. I don't care if it hits 100. I don't care if it hits 120. The metal stays in the safe. Trigger number 2, registered inventory movements. I'm watching the COMEX warehouse reports like a hawk. These come out daily and show you exactly how much silver is in the registered category versus the eligible category. Registered means it's available for delivery against futures contracts. Eligible means it's just sitting in the warehouse, but not earmarked for delivery. If I see large amounts of silver moving from registered to eligible, it means the big players are tucking their metal away. They're taking it off the table. They're making it unavailable for the scramble that's coming. That's a bullish signal. Trigger number 3, the dip on "It's just a bluff" headlines. If silver dips toward $85 this week because mainstream media runs stories about how this is just a negotiating tactic and cooler heads will prevail, I am personally looking to add to my physical stack. I view that as a gift. It's the market giving me one last chance to buy at a discount before reality sets in. I'm not talking about leverage. I'm not talking about futures contracts or options. I'm talking about physical metal that I can hold in my hand. Trigger number 4, margin hikes above 20%. If the COMEX hikes margins by more than 20% in a single day, I'm sitting on my hands. I'm not playing the paper game at that point. Margin hikes are a signal that the exchange is trying to suppress price by forcing speculators out. When they're that aggressive, it usually means the physical situation is worse than they're letting on. At that point, I let the physical metal do the work. I don't try to trade around it. Trigger number 5, the London-New York spread. This is the nuclear option indicator. If the spread between London spot prices and New York spot prices hits 5% or more, I'm preparing for a force majeure event. Force majeure is the legal term for we can't deliver because of circumstances beyond our control. It's the escape hatch that exchanges use when they can't meet their obligations. If that spread hits 5%, it means arbitrage has completely broken down. It means the one-way valve is fully closed. It means we're in uncharted territory. And at that point, my personal plan is simple. Hold physical, avoid paper, and wait for the dust to settle. Here's something that doesn't get nearly enough attention in these squeeze scenarios, and it's critical you understand this. Industrial demand for silver is not optional. It's not like investment demand where someone can decide to wait for a better price. If you're a solar panel manufacturer, you need silver. If you're making semiconductors, you need silver. If you're producing medical devices or electric vehicle components or military hardware, you need silver. And you need it on a schedule. You can't just tell your production line to pause for 3 months while you wait for silver prices to come down. Your contracts have deadlines, your customers have orders, your factory has overhead. So what happens when industrial buyers realize that the normal flow of silver from COMEX to wherever they need it has been disrupted by a 25% tariff? They panic buy. They lock in supply at any price. They build inventory buffers they normally wouldn't carry because the cost of running out is higher than the cost of overpaying. That industrial bid, that non-price sensitive demand, is what pushes markets over the edge. Because industrial buyers don't care if silver is at $90 or $110. They care about securing supply. They care about keeping their production lines running. When you combine that industrial bid with a geographic arbitrage trap that's preventing normal supply flows, you get a price spike that doesn't respond to normal market dynamics. The banks can short all the paper they want. It doesn't matter. Industrial buyers need physical metal, and they're going to pay whatever it takes to get it. And here's why I'm not worried about a crash this week, which might sound counterintuitive given everything I've just told you. I don't think we're going to see a crash this week. I don't think silver is going to fall back to $70 or $60. Here's why. The market hasn't fully priced in the tariff trap yet. Most participants are still operating under the assumption that this is a negotiating tactic that will be resolved before February 1st. But the smart money, the institutional players who actually move physical metal, they're not selling. They're holding. They're waiting to see which way this breaks. As long as physical holders aren't selling, there's a floor under the price. Could we see a dip to 85 on "it's just a bluff" headlines? Absolutely. I'm planning for that scenario. But a full crash back to the 70s? I don't see it. There's too much physical demand, too much industrial buying, too much awareness among large holders that something structural is changing. The downside risk is limited. The upside risk is unlimited. And that's a risk-reward profile I'm very comfortable with. If you're someone who trades silver futures, who uses leverage, who plays the paper market for short-term gains, I want to say something directly to you. You're playing a game that's about to change its rules in the middle of the round. The normal patterns don't apply anymore. Normal support and resistance levels don't matter. Normal correlations with the dollar or with gold or with equities are breaking down. When you're trading a geographic arbitrage trap scenario, technical analysis is almost useless. You're not trading sentiment or momentum. You're trading logistics and policy. If you're on the short side of this trade, either directly or through selling covered calls or any other bearish strategy, you need to understand your risk is not symmetrical anymore. The downside might be $10. The upside might be $50. And margin calls don't care about your thesis. I'm not telling you to close your positions. I'm not giving you advice. I'm just saying, understand what game you're playing. Understand that the referee might change the rules. Understand that the floor could fall out or the ceiling could blow off, and your stop loss might not protect you. We are now 14 days away from February 1st when the 10% tariff officially kicks in. 14 days for the LBMA to source metal. 14 days for the banks to reposition. 14 days for Greenland negotiations to either produce a deal or fall apart completely. 14 days for the market to wake up to what's happening. I've been doing this for 12 years and I've never seen a setup quite like this. I've seen supply squeezes, I've seen price manipulation, I've seen regulatory changes and demand shocks, but I've never seen a scenario where a single policy decision created an immediate structural barrier to the normal functioning of a global commodity market. This is not a prediction about silver going to $100 based on investment demand or inflation fears or dollar devaluation. This is an observation that the plumbing is broken. The pipes that normally allow silver to flow from New York to London have been crimped by a 25% tariff, and nobody has figured out how to uncrimp them yet. When plumbing is broken, pressure builds. It doesn't matter if anyone wants higher prices. It doesn't matter if the banks try to suppress it. Physics doesn't care about your short position. Let me talk about the Greenland variable because this entire tariff structure is theoretically contingent on those negotiations. The administration has made it very clear, make a deal on Greenland and the tariffs go away. Fail to make a deal and the 10% becomes 25% by June 1st. So the obvious question is, what are the odds of a deal? I've been reading everything I can find on the Danish government's position, on Greenland's own political situation, on the broader geopolitical context. Here's my personal assessment. The odds of a comprehensive deal by June 1st are below 30%. Here's why. Greenland is not just a piece of real estate. It's a sovereignty issue for Denmark. It's a cultural issue for Greenlanders. And it's a strategic issue for the entire European Union. Because if the US gains control of Greenland, it fundamentally shifts the balance of power in the Arctic. This isn't like buying an office building. You can't just write a big enough check and close the deal. There are political constituencies in Denmark that would rather see their government fall than sell Greenland. There are Greenlanders who view any sale as a betrayal of their autonomy. And critically, there's no urgency on the European side. From their perspective, they can just wait out the tariffs. They can absorb the economic pain. They can hope for a change in U.S. policy after the next election. They're playing a long game. The administration is playing a short game, which means the odds of a breakdown in talks are significantly higher than the market is currently pricing in. Every day that ticks by without progress is another day closer to February 1st when the 10% tariff kicks in. And every day after June 1st without a deal is another day under the 25% regime. I want to address something that drives me crazy about how most people analyze precious metals markets. They look at price charts. They look at technical indicators. They draw trend lines and Fibonacci retracements. They try to predict the next move based on patterns. All of that is fine for normal markets. It works reasonably well for stocks or Forex or even gold most of the time. But silver is not a normal market. Silver has a physical supply constraint that doesn't show up on any chart. You can't see a geographic arbitrage trap in a candlestick pattern. You can't draw a trend line that predicts a force majeure event. The price you see on your screen is a derivative of a derivative of a derivative. It's a futures contract based on a spot price based on a flow of metal that may or may not actually exist in the quantities the market assumes. When that underlying flow breaks down, the chart doesn't give you any warning. The chart shows $89.94. It shows a 1.62% decline from Friday's close. It looks calm. But underneath that calm surface, the physical market is seizing up. Dealers are widening spreads. Refineries are backlogged on orders. Industrial users are panic buying because they know what's coming. None of that shows up on the chart until it's too late. By the time the chart reflects the physical reality, the move has already happened. You're not getting in at 90. You're chasing it at 110. This is why I focus on physical inventory data, on spreads, on delivery patterns. Those are the leading indicators that actually matter. The chart is the lagging indicator. It tells you where we've been. It doesn't tell you where we're going. And if you want to stay ahead of what's coming, you need to be watching what I'm watching. That's why channels like What Happened After exist, to cut through the noise and focus on what actually moves markets. Let me paint you a picture of what I think the next 3 months look like if this tariff holds. By early February, we're going to start seeing a persistent premium for physical silver in London relative to New York. It'll start small, maybe 2 or 3%. Mainstream media will call it a temporary dislocation or regional supply constraints. By March, that premium will widen to 5 or 6%. Dealers in London will be charging $100 per ounce, while New York is still trading at 95. Arbitrage traders will look at that and say, why don't we just ship metal from New York to London and capture that $5 spread? Then they'll remember the tariff. They'll remember that shipping an ounce to London means paying a $9 or $22 tariff to bring it back. They'll realize the arbitrage doesn't work. By May, if there's still no Greenland deal, we're looking at a 10 to 15% spread. London silver at 120, New York silver at 105. At that point, the LBMA has a choice to make. Do they keep allowing physical delivery at these elevated prices, or do they implement cash settlement? If they choose cash settlement, confidence in the entire system evaporates. Every holder of a London silver contract realizes their contract is not backed by actual metal. It's just a paper promise that can be settled in fiat currency at the exchange's discretion. If that happens, the flight to physical accelerates. Everyone who thought they owned silver through an ETF or a vault storage program suddenly realizes they own a claim on silver, not actual silver. And the premium for metal you can hold in your hand goes vertical. This is the two-price world we're entering. Paper silver at one price, physical silver at another price, and a widening chasm between them that no amount of financial engineering can bridge. I've been through a lot of silver rallies. I was around for the 2011 spike. I've watched countless to-the-moon predictions fizzle out. I know that a lot of people in the silver community have developed a kind of cynicism about squeeze narratives. We've heard it all before. This is it. This is the big one. The banks are finally going down. And then nothing happens. The price rallies for a week, the banks slam it back down, and we're back where we started. So let me tell you why this time is structurally different. Every previous squeeze attempt has been demand-driven. It's been about investment demand overwhelming supply. It's been about retail buyers or hedge funds piling into the market and trying to corner physical metal. Every single time, the banks have had the same response. They short more paper. They lease metal from central banks. They move physical inventory from other global vaults to wherever the pressure is building. They've always had geographic flexibility as their release valve. This time, that release valve is gone. This isn't about demand. This is about supply chain paralysis. This is about a policy decision that has created a structural barrier to the normal flow of metal. You can't short your way out of a tariff. You can't lease metal from a central bank if that metal can't economically cross the Atlantic. The normal tools the banks use to suppress price don't work when the fundamental problem is logistics. And that's why this week could be the catalyst that finally breaks the paper market. Not because of some grassroots movement or coordinated buying campaign, but because the system itself has been structurally compromised by forces the banks cannot control. It is Sunday evening, January 18th, 2026. Silver is trading at $89.94. The markets are quiet. Mainstream media is talking about Greenland and diplomacy and geopolitics. Underneath all that noise, a physical liquidity trap is tightening around the LBMA. In 14 days, the cost to move silver across the Atlantic increases by 10%. In less than 5 months, if negotiations fail, it becomes 25%. The banks have papered over physical shortages with derivatives, leasing agreements, and accounting tricks that let them count the same ounce in 3 different places. But you can't paper over physics. You can't negotiate with mathematics. The train is already in motion. The only question is whether you're positioned for what comes next. Stay sharp. Stay informed. And if you want to keep tracking this situation as it unfolds, make sure you're following what happened after, because when this market moves, it's going to move fast, and you won't get a second warning.